Okay, another video, 8 a.m., April 9th. It's Wednesday, right? I think it's Wednesday. Um, so this is going to be a great video. I'm going to take a minute to show how I trade, how I think about trading. And I'm sort of going to try and do this live because to give you an idea really how I think about markets and trading with gold. Because right now I really ought to buy gold, and I'm not long gold. Now I did buy it overnight and I made some money in it, but and I sold. Um, I've made money on this rally here, and then I sold it around 30.63. You can see it's continued higher, and it really is still a buy, meaning high probability for continuation and so on and so forth. But I'm a little skittish right now, but I may watch it for a little while longer and buy it. But I just want to give you a background of, you know, this market is the strongest market out there. So in general. So, we have this recent crash. This is the daily. So this is the daily chart. Each one of these bars is 1 day. Okay. This chart, every bar is 11,000 contracts. So that means the time varies. Whereas this, every bar here represents a period of time, which is 1 day. And most charts are like that. It could be a 10-minute chart. It could be a 120-minute chart, which is 2 hours. That's typically what people think or look, but I don't really use those much. And the reason is because they're pretty flat, or to me, they sort of, the lines you draw across those charts, these 24-hour markets, technical analysis lines and trend lines and visuals and stuff don't seem to work out as well. Whereas if I use these volume charts, which is this one and this one, the lines just appear to line up better. The technical analysis appears to work better. And so if overnight a contract trades, you know, 50,000 contracts, in a 10-hour period overnight, it might trade 50,000 contracts in the first hour of trading, and you're going to have two bars. But who cares about time? That's how I look at it. It's money that moves markets and where those trades were made. And I've just adopted. I love these charts. Not all brokers have them, but TradeStation has them. That's what I use. They work great. But I use that in conjunction with the daily. Um, so with gold, before this crash stuff started happening, this is this strong chart of gold. So, I'm watching this go up, and I think, one of the other trading videos I made, I said, okay, it needs a rest. Okay, time to buy it. I didn't do a great job. I didn't make a lot of money in it going up or shorting it. But, this daily chart. So basically, I've got two indicators, right? So these are candlestick bars, okay? And then I've got two indicators right now. I've got this green thing. It's just a 2-period rate of change. It's literally just telling you sort of like, is it up or down? Where is it in the rotation? So it's been down. So if you can see it low down here, it's been down a couple of days. Maybe it's time to buy. This is something you can sort of look at, just the time you're buying. Obviously, you want to be buying when it's been down, or if you're short selling, you want to be selling when it's been up for a couple of days. That does not characterize the way I've been trading lately, where it's sort of typically more patience. You have to wait a little bit longer for opportunities. Whereas lately, there's so much volume and volatility. It's like every 12 hours, it's like a new idea, a new. So what you do is, wait, wait, wait for your spot. And normally, I'm looking for a sell-off and then a momentum move out of it. Because I know if it's sold off, the day traders are out, money's out, and that means that, and there's some shorts that have come in. So the next move will, if it's up, and when it's up, there will be more momentum and more buyers to drive it higher. Um, so like this is the biggest nice run we had that was just consistent. And you can really see here how it just ran out of steam, and so you have this top area. So I was avoiding it, even though it had been so strong, and it's making new highs. But after this thing and this thing, it's sort of a buy here to go higher. So that sort of sets up. So, you know, that's discretionary. That's sort of trying to figure, okay, we have a sell off. How deep was this sell off? And if it's this deep, it's probably not just going to shoot right back up. You don't want to necessarily buy this bottom. Want to wait for some sort of consolidation, and then this is really the time you want to be buying it. You have this consolidation, it breaks down, you have this one. So that's sort of the idea. Now, these little crosses are telling me if it's an inside day. It just is the more of these that show up in a row and on a particular day is sort of telling me it's been some consolidating for a couple days. It's been quiet. It means a lot of volume and volatility has come out of it, and it might have an opportunity to move. So that's sort of what I'm looking at. Now look at this. Look at this. Even amongst this volatility, um, and by the way, when I say a three-bar triangle, it's the same idea. Now the inside day of these crosses, it just means that this day is the high and low are inside, meaning the high is lower than the high of the previous day, and the low is higher than the low of the previous day. It means it's consolidating. It means it's less jumpy, less volatility. You can see there's two of these that came within 2 days, and then you have this rally higher. The three-bar triangle is the same idea. It's a consolidation pattern. It's just instead of it only being one day inside of the prior day, it's one day inside of the prior 2 days. So the three-bar triangle just has a little bit more. There's more of them that are going to show up because you have an extra day. Um, but those patterns tend to work quite well too. So you even had an inside day yesterday. Look at this. So this day obviously was outside this day. This day traded below this, so it is. This day traded below the prior day, so that's not. But this day, the low was above the low of the previous day, and the high was below the high of the previous day. And sure enough, what did you do? You're going to break out in the other direction. So these are helpful, you know. Knowing that it's the strongest market, I expect it to break to the upside first. So it's sort of like you're watching it fall and break down, and you're just sort of waiting. Okay, wait for the money to consolidate and wait for things to start to perk up a little bit to give you clues. Okay, there's going to be a little bit of consolidation. The better markets are going to start to move higher. The stock market's probably hasn't been strong lately, so it's probably not going to lead the way up, but it's probably going to consolidate while some of the better markets move higher. So, anyways, that's sort of the thinking that goes into it on this daily chart. Now, what I have is on my radar screen, or it's this screen where I've got all my quotes. Um, I've got this, I've got these other sort of daily indicators that give me relative strength that tell me the strongest and weakest markets. Of course, if you look at gold, this short-term RSI has been weaker, but longer term it's been better, but it hasn't been better the past few days, whereas you can see like the yen has been stronger the past few days. Some of these other currencies, corn has been hanging in there. Um, but what I'm what I want to look at here is here's today's volume, this column here. But this column, I have it's the average volume over some period of time. So in this case, it's the average volume over the past 100 days. Okay. And then bars per day, 17. So it takes the average volume and divides it by 17. Why 17? I've just did so many tests, always tested for breakout systems and range trading systems and all kinds of things. And I just ended up always coming back to this number of about 17 bars a day, which divides the day into about, if it was divided evenly, it'd be about an hour and a half per bar. But there goes gold shooting higher. But it's 8 a.m. So stock market opens in an hour and a half, but 8 a.m. is a bonds open, and yeah, it's just a lot of traders have just sort of decided that's a good time to start trading, to open their trading day. Gold technically it doesn't open until 8:20 a.m., so it's 20 minutes before. So you'll see a volume pickup also at 8:20 a.m., but you can see gold pushing higher here. Now, the reason I don't want to chase it is because it's the first day out of the move, and like I showed you on this chart, it's like, and also we have these wide bars back and forth that we could easily come back quickly. Um, But like this sell-off, you see, if you chase it up here, you might sort of get screwed over when it comes down a little bit. That's just the case here. Like here, it shoots down and you buy this first day up and then you get screwed. So you come down here and you have these times where if you chase it and you sort of get left in the dust. Here's an example. You try to chase this up and you get left in the dust. So I don't necessarily like to just chase it at this point, and so that's sort of why I don't have a position on. But if I'm catching a momentum early off a bottom like I did this morning, it tends to be a good position. But chasing it later in the day when it's been down, a lot of times it'll come back and retest, or so a little bit skittish about it. But sometimes if you just jump in and have a tight stop, you can do it that way too. Okay, so that's sort of the daily. So these charts, which I said I divide the average volume into 17 bars. So each one of these bars represents 11,000 contracts. So I took average volume for gold and I divided by 17, and it comes out to be about 11,000 contracts per bar. Now you can see between days, these little vertical grid lines show the distance between a day. So you can see that sometimes they're wider than others. Look at this big volatility day, and you have this one day, it's much wider than these other days. And that's because this was a light volume day, and this was a very big, heavy volume day. And of course, you could see the bigger move. You see, this is a very heavy volume day because of the width, and then this is a lighter volume day. So the idea being that, this represents volume, not time. Okay, so we've had this. One of the characteristics of the strongest markets is that when they sell off, they usually bounce back quickly, whereas a weaker market sells off and then it might make a flag, more of a sideways to upper movement before it breaks down again. So every time this is coming down, it's jumping up quickly. You could see. So there's more confirmation that this is a really strong market. And these markets, normally they get up here about halfway and then they sort of crap out, then they might retest. Again, that's why I don't want to buy it just yet necessarily. Now I could buy it right this second and then do a really tight stop and probably come back and hit my stop, but or just try to take a few bucks out of it. But this is the idea, is waiting for it to sort of maybe do a secondary test. Once it confirms, okay, this is an uptrend, right? This is a downtrend, right? For 1, 2, 3, 4 day downtrend. You can draw lines, you know, what a downtrend looks like. This is lower than prior lows, and this high is lower than prior highs. Now this one, sort of didn't follow this pattern. This is a higher low, but generally, you can have these interim ones, but generally new low. This this is did not go higher than the previous high. New low, lower than this low, but you could see how much lower this low is. This one barely went below this low before it popped up. And then you see this bottom put in and is not a new low. So once you have a bottom put in, it's not a new low. Crossing over this doesn't necessarily make it so. Okay, you can see from here, this was not lower than this one, so it could go up, up, and then break, and the downturn remains intact. So this could have gone down, it could have gone up to anywhere here, but once it gets past this level, now we say, okay, now it's sort of confirming this has the potential to be an uptrend, because now you have a higher low, and now you have a higher high, right? So we can see sort of how that works. So now we're saying, okay, this is now looks like it's going to be in an uptrend. First rally up, probably have a correction, a decent sized correction, and it's later where these corrections usually get smaller. Not always the case. If this was strong enough, heck, it could go back up here today. If it gets up high enough, you almost sort of have to buy it, but again, that's not the probability. Now, looking at this oscillator down here, high momentum, highest momentum. Okay. This sell-off slightly less momentum, but then we had some follow through here, big momentum down. So these are both hot, this leg down, high momentum, this leg down, high momentum. This leg also had decently high momentum. Now keep in mind the market was also selling off hard this day. But so we didn't really get much of a divergence, only just that this is only a little bit lower. Um, but we can see, importantly, you know, this loss of momentum on this sell-off. Of course, that meant a lower bottom gutment. And then we can see increased momentum on the upside. So this is why this looks like this is going to be the next buy, which we've known that it was the strongest market before, and it'll probably take take leadership again. So that's what we look at now. In terms of trade placement, so I sort of get my bigger picture from the daily, from this 11,000 contracts per bar, and then I drill down to a even smaller one. So this one is 3,000 contracts per bar. So this is a whole day. So this chart even looks a little bit different. Now what I do is I can come in here and I can go all the way back. I've made this, there's a lot of bars here. I've gone all the way back to December, but we can start and sort of look at this latest rally that we had that made it up to 3,200. So there's 3,100 and there's 3,200. And we see how choppy it got up here. So let's look for a minute here. So for instance, we can go back to 30. So this is March 14th. So if I go back on the daily to March 14th, so that's around here, this little consolidation area. So we can look at this at a shorter time frame. I don't know if this has March 14th on it, probably does. So we look at March 14th, and I'm just sort of comparing what's happening now, but yeah, you could see this long consolidation. So we had the sell-off, came in here. We have their first bounce, which is sort of what we're doing right now. There's your first bounce. That's why I'm sort of saying, okay, I caught this off the low, but I'm sort of saying, okay, I'm a little bit scared here because it's probably it might do something like this for a while. Might have to consolidate. Okay. So looking at this daily chart, here. Right, so this is this consolidation. Your sell off, your consolidation, and then waiting for it to break. This is about 2970. This is about 3,000. So, so then you drill down, when you're looking at this one, and sort of watching that play out. There's that secondary leg up, sort of where we are right now. This is like, it's like the equivalent of where we are now, off the bottom. We have this sort of consolidation. It dips below that consolidation and then it rallies. So we sort of get this breakdown. And then and that's what I keep saying. Once it breaks above this is that's buy time. And look at this. You didn't get any pullback. So you have your low, your consolidation break, and then confirmation. This is no longer in a downtrend. And then that's when the stronger rallies happen. And the first one, breakout, and then this tiny little consolidation. No need to sell here. Smaller consolidation, and then it goes to its highs. Then you have a bigger retracement, and then a very strong move up. 3-day consolidation, strong move up. This is a little bit choppy, but not so much. You want to hold that. So normally the first breakout, and when it really comes up strong, you don't want to sell it. You want to wait for maybe the secondary one, and then you could see it sort of runs out of steam up here, starts chopping. And that's when I say, okay, look, it's running out of gas. You could see big momentum, big momentum. This is a divergence, meaning it makes a new high, but momentum does not make a new high. And then more divergence, not making new highs, but really struggling, and then you end up with your sell-off. And that's sort of how they always look. and then you have your sell-off, which we're having now. So if I go back and I look at follow this out in the really short-term time frame, going back to March 14th, you know, there's that low with the big momentum, comes up off the bottom and consolidates, right? So this consolidation for days, and then it looks like it's going to break lower. Then it comes back up to this new level of consolidation, dips down, and then this is buy time right here. And you see this big momentum thing, and then you can sort of follow it. So we're not here yet. We're sort of like just comparatively, we're more like in this area where it just took off the bottom, or actually sort of like this area too. This took a day, and then this one, whereas this sort of came up, and then we're just in sort of 1 day time frame. But that's the idea. So we come to present day, and we sort of want to see that sort of same thing. The bottom getting put in, bouncing off that bottom. There's your low, and then we're shooting up. You can see that first rally up. So, it's just very textbook of doing the same types of patterns, but not the exact same thing. Whoops, I was going to look at the daily. Where's the daily, my daily chart? Yeah, here it is. So that's sort of where we're at. It's like we've made this low. We've got to rally up, but we're still going to wait for it. We got this low and this first rally up, and we're going to wait for it and see what it does over the next couple of days. That's the idea. But keep in mind too, we're also later stages, and that's important to know what stage of a rally you're in. When at the beginnings of a bull market, it's choppier, um, but when it breaks out of these low areas, each successive time it gets stronger, and then sometimes it won't even come back down, and then you'll just get sideways. Then it'll break out. You have a small flag, and then it'll make its high, and then it'll spend a little more time, and then three. It sort of like comes in threes. 1, 2, 3, then it breaks down. Then this this you can see how big this break is. So it's sort of like still the beginnings of a. It's hard to trade. It's always hard to trade. It's always hard to make money. And at the beginning, it's really hard to stay long because you're sort of not sure. And a lot of traders are still figuring out if this thing's going to keep going up. Now we're in a more mature market, which means more volatility. You can lose money quicker, but we sort of know who the leader is. We just have to be careful about when we get involved with it because it's not going to take this long. I mean, this was like November 1st, and before we made a new high, it was all the way in February. So it was like 3 months. Whereas for us to get back to a new high here, it's not going to take 3 months for us to get back to a new high. This is going to look more like this rather than this sort of most likely, unless the market keeps. But, we've got this big down here. So a little bit of a bounce, a little bit of a consolidation, and then we'll find some area. At least we'll at least have one down day or one day that'll sort of scare people that might go down again. And then once it breaks through the high of that first breakdown, which is this equivalent of this spot, that's sort of when you buy. So this is the same. I mean, it's the same concept. You come out of this bottom, and then you have some sort of consolidation, and this is a very ugly looking one, but you sort of have this happen, then it crashes down. Okay, we're going to take a minute before we get up there. Comes up here, crashes down. But once it's done this twice, that's your breakout point. That's your spot where you should say once it comes above this, it's not at a new high, but it's at that. It comes above that first, attempt to rally. And so that's sort of the idea. And then once it gets above this, it's sort of a buy, and you can see there it is coming up above that. There's your buy. So this one, whether it comes up for another day or 2 days or halfway, then maybe it comes down a little bit. But that spot, wherever that spot is, the new high it makes today or tomorrow, and then it'll consolidate more. That usually is your buying spot where you want to come in. And that's the equivalent of this idea here. This idea here, you have this high, this bottom gets put in, and then this one was a little bit not quite the same, but you have your first rally back, and then you wait, comes up, then it comes down a little bit, and that's all you get, and then that was your little spot. This is literally the top of this day. It comes up, then it starts to look like you have a negative feedback. It's going down again, but it doesn't go down as far. It doesn't make a new low, and you sort of put your buy stop at the high of that day. That's sort of the idea. So that's sort of where we're at with gold. We'll look for this intermediate first new high of a smaller trend, not of the big trend, of a smaller trend. We'll look for some sort of intermediate high, you know, like this, some pullback, and then once we start to get some momentum out of that pullback is sort of when we're looking to buy. So that's sort of what we're doing. I just caught some momentum off the bottom, but I sold out of it quickly because of this. This is sort of the idea. Because of, quick rally back and then you get out because this sort of thing happens. So that's sort of where we're at. That's sort of what I'm watching. And sure enough, it's sort of that concept is sort of playing itself out right now in real time because you could see, so you get this first rally, you get this flag. It doesn't come down a lot. It just sort of stays sideways, moves a little bit higher, but then you get this red bar down. And you say, okay, this isn't that strong. It's not really, uh, this is becoming more volatile and choppier. Meaning, it did go through this other high here, so you got some excited buyers, but it's just there's still some long-term sellers, some bigger funds that are probably liquidating still and are not done completely liquidating. You got the first crowd that chased it off the bottom. They're a little too early, and so that's why we're just sort of. And then the other important thing is this leg, you know, didn't have any bars that look like this. This leg was very long in length, so very safe. You're not really getting stopped out. Whereas this one, is just little thing, only 2 bars, and then it sort of crapped out. This one, that'd be like it coming up 2 bars out of, some consolidation and then crapping out and sort of saying, I don't know if I'm going to go anywhere. You have this long leg up. So this could easily, it'll probably go up and make a new high today, but I just don't think it's going to run a lot further from here. So I'm sort of waiting on it. So anyways, that's sort of a how-to on trading. So a lot of the same ideas play out when markets are going down, but with modifications because markets go down a lot quicker, and then on the retracements, those can be real nasty, and and generally you have less time. You stay in those trades for less time, but a lot of those same ideas play out. Um, so, anyways, that's sort of some thoughts on how I trade or how I'm trading gold or how you trade the strongest market. So, anyways, hope that gives more insight into what I do.